Hello and welcome. The UK housing market is in headline news again as fears rise over the impact of high mortgage costs on consumers and the potential for a housing market slowdown. Average mortgage rates have soared since the Bank of England embarked on its interest rate hiking cycle just over 18 months ago, and there's little respite on the horizon, with interest rates expected to rise further in coming months and current average mortgage rates close to their 15-year highs. Worse still, around 60% of mortgages that are set to be renewed in 2023 are rolling off deals that are set at less than 2.5%. Quite the shock for those homeowners set to remortgage this year and beyond. Now, it's often said that as Brits are obsessed with owning our own homes, and the stats show that as households we take on much more debt than those in other countries. So how concerned should we be? Are we facing a situation of increased mortgage defaults similar to the global financial crisis and a sharp fall in property prices? Well, from an affordability perspective, there's no doubt that mortgage expenses relative to income have increased significantly. That means at current levels, the percentage of average income required to finance the average UK house has risen from below 20% in mid-2020 to just over 60% today. That's an alarming rise, and it speaks to the challenges and sticker shock that some consumers will face as they refinance their mortgages. But how big is that refinance problem? Well, the good news here is that compared to the global financial crisis, many more UK mortgages today are of a fixed rate rather than variable rate structure. In fact, around 85% of outstanding UK mortgages are fixed rate, and that means the impact of higher interest rates is delayed until the refinancing point, though that will be little comfort to the 1.4 million households that need to refinance a mortgage in 2023. The number of households facing higher costs, therefore, will continue to increase over the coming year, though the Bank of England still expects the share of households with high debt service ratios to remain some way below its historical peak. And the affordability rules brought in after the financial crisis to avoid over-leveraging the mortgage market look like a savvy move by regulators. Loan-to-income ratios have been capped, stress tests have been implemented on borrowers to ensure affordability in the event that interest rates rose sharply. And there are now also stricter regulatory conduct standards for lenders with respect to supporting households with payment difficulties, enhanced by the new mortgage charter adopted by lenders in June. And that stops lenders repossessing homes within 12 months of the first missed payment, and taken collectively, that's helped keep mortgage arrears and defaults below pre-pandemic levels, despite the headwinds that mortgage holders have faced. And that brings us neatly on to UK house prices and the risk of a housing crash, as we saw in the global financial crisis. Despite the worrisome headlines and struggles with affordability, here we are not yet seeing year-over-year declines in the average UK house price. Prices have moved down from their peak, as would be expected as interest rates and mortgage costs rise, but so far price declines have been limited by robust demand and constrained supply. That is, there remains support for the housing market in spite of higher interest rates because demand outstrips supply in many areas. Now, activity as a whole is certainly lower in terms of the number of transactions, but the supply and demand mix should help keep house price falls contained relative to the global financial crisis. And avoiding a significant fall in prices will also help maintain household wealth, and it will avoid high proportions of households falling into negative equity, where the value of the property falls below the value of borrowing. So there are risks to the UK housing market in the form of higher interest rates, but the market today is structurally much more resilient, and regulators have learned from the financial crisis. So where will we see an effect, and what are we looking out for? Well, we continue to monitor many of the dynamics I've discussed today very closely, but we're also keenly watching the effect on consumer spending and on confidence for signs of unease or caution in wider consumer activity. Higher mortgage costs take away money that would otherwise be spent on the wider economy, and rising mortgage overpayments are a sign that caution is becoming broader. That said, consumer confidence has been on the rise of late, despite the mortgage market rose as competing costs such as energy prices actually fall. Thanks for watching.